US inflation is off the charts and the bond rates have skyrocketed today. Olivia Chow says she wants more affordable housing in Toronto. This is what we talk about with our good friend Dion Begg, and he even predicts a huge prediction, my friends, from Dion today. Perhaps we are starting to enter into a recession. So let's dig into it and jump into the studio. Yes, my friends, as promised, some crazy things are happening in our market, but that's why we invite our good friend Dion Begg. How you doing, my man?
I'm great, man. How you doing?
Excellent. So, as I said in our little preamble, which you haven't seen yet, but we've got some nutty things going on. Of course, we had a big election here in Toronto for the mayorship, and we're going to talk about that and Olivia Chow's dream for Toronto home ownership and also to make it attainable. I think that's probably the right word for it. And of course, we've had some inflation numbers come in from the feds down to our big brother in the south, and that's affecting our markets up here. But where do you want to start? You want to start with the mayorship and talk about
Let,
that?
let's let's start there. There's a lot to talk about, but yeah, let's start there. So just this week, Toronto elected a new mayor, Olivia Chow. Every mayoral candidate, their number one discussion point on all the radio stations, TVs, was of course housing. Because everybody's feeling that pain, whether you're a home owner, a renter, or a want to be home owner, everybody's feeling this upward pressure of costs. And yeah, I think the key word is affordability, right? We are unfortunately becoming a city, and even the greater Toronto area as a region is becoming a city that's just a lot less affordable than just, say, 10 years ago, proportionate to income. And so, yeah, we've had some major challenges. You and I every day deal with people who are trying their best and are buying the maximum property they can, which again is probably in some instances much smaller than they would have got again just 5 years ago.
Yeah, and it's interesting because obviously home ownership, or I should say, having a place to live. That's really what she's all about. To kind of really peel that onion away. And we know because of most recent interest rates and the lack of rental stock, that rental rate has skyrocketed in the Toronto area, as well as obviously the valuations. And she's got some interesting things on what that looks like. I know you had sent me some information about, some new bills that are coming out and what percentage will be at market rents, and then kind of break that down for us. What's after that?
Yeah, so one of the things that are on the table right now, proposed by her, is the development of 25,000 housing units in the city of Toronto, in the municipality of Toronto. And these would actually be government initiatives, meaning when she's not, it's not that they're making more land available for developers. It's the government themselves would be the developer of these units. And construction of, I guess, government housing is the terminology we might use here, which often has some negative connotations. But the distribution of how that's going to roll out looks very different from what your regular sort of government housing, like the projects in New York, for example. It doesn't look like that's what she's wanting, which I think none of us want. But yeah, 25,000 units. Now, the breakdown there was 70% of them would still be rented, but just at market rent. So, really, I don't see how that's going to impact affordability if they're just going to be charging the same as a real estate investment trust would be charging, or a private landlord would be charging. So the vast majority of them will be just at market rent. 20% would be at 80% of market rent. So sure, that's a step in the right direction. And then the others are going to be tested on income, and that's the remaining 10% would be rented at 30% of household income. So if that household made, put simply, $5,000 a month, then the fee, the rent cost there would be $1,500 a month. So I can understand how that lower end will impact people in a positive way, so that we're capped at that 30%. And isn't it funny, Gary? back in the day, you and I were taught, yeah, you should only spend 30% of your income on housing. And that was true maybe 15 years ago. But I can tell you, when I look at these debt service ratios every day, this 30%, which is like, oh, that's a relief. That should be normal. But now everybody's pushing all the way to the max, which is around 45%
Yeah.
of household income is going to rents or to mortgages right now. But yeah, so that's what the proposal is. I can't see that having a huge impact, especially in the face of the population numbers that just came out in the last little while.
Yeah, with over 1 million people coming to Canada and everything else, that has a dramatic impact on lots of things, infrastructure, let alone your valuations and availability of homes to rent and to buy and units to buy. It's interesting too. I know we're just talking about a small number of 10%, 2,500 units based on that equation that you talked about there. The other interesting thing too, the ripple effect from that, right? If I have one of those units, say if my income is $5,000, and in that scenario my rent is $1,500, the weird ripple effect in my brain, because you and I are both entrepreneurs and we think bigger. I don't necessarily want to achieve greatness at work. Meaning, I don't want my salary to increase dramatically because that means my rent is increasing and everything like that. Like that's that weird ripple effect, right? Of course,
Yeah,
that's not going to be for everybody, but that's just the way I see it.
yeah. I mean, it's effectively a disincentive to
Yeah,
earn more because
yeah,
you'll end up paying more. But I would hope that, well, it comes down to psychology of the person in there. Hopefully, some of those people do want to, move up to that next level on the economic ladder, and hopefully, the purpose of that type of housing is really to provide that first step so that they can
that's it.
then take that second step. Let's hope that that's the kind of people who end up in that type of housing, and they can then go off and be homeowners someday.
Yeah, yeah. And that's the way we need to look at it. It's that stepping stone, that bridge, that gap, and so forth. And we know many people that could use that for sure, for sure.
Yeah,
Yeah, the immigration numbers that we're seeing are certainly having a dramatic impact of what's going
yeah.
on in the
So
GTA
look,
area. Yeah,
it wasn't just a couple of weeks ago. You and I were talking about the headline of that day, which was 1 million immigrants in the year 2022. But just recently, they published the rolling 12 months, right?
yeah,
And if you look at the last 12 months, not just the calendar year, but just the last 12 months looking back from now, that number is not a million. It's 1.2 million people entered Canada in the last 12 months. More than 290,000 entered in just Q1 this year, right? And that was that entry, that 290,000 that came in Q1 this year. I think the year I moved to Canada, which is 15 years ago, that was the entire growth of population of
yeah.
immigration that year, right? We crammed that into one quarter.
Yeah, that's bigger than majority of all the cities in Canada, 200,000, 290,000, right? And like, and it's important. And I know if you're watching this, well, why does that matter? Why does that care? There's so much that comes out of that, as we just talked about, the infrastructure and the pricing of what, from gas to food to everything. It has a dramatic impact on that. So okay, let's segue into the inflation and into the bond rates. And you sent me some stats earlier about the bond rate increasing today, and you were like, where does this come from? Why is this happening? And we had to go do a little homework.
We really did because, as of, well, if I just start with the inflation numbers, when they came out early last week, uh, I looked at that and I said, well, with the July 12 interest rate announcement around the corner, these lower inflation numbers dropping from 4.4 to 3.4, significant drop in a month. I'm like, okay, well, if the government is really using this as an indicator, then we have a high chance that we won't see any negative stuff happening at this next announcement. That is, it in my mind, Monday of last week, in my mind, I was like, you know what? We're probably not going to have a rate change, right?
Hmm.
Then after that, we had retail spending numbers come out, Canadian employment numbers come out, and then yesterday we had U.S. employment numbers come out, and so this morning when I woke up and just before I jumped on this call with you, I went and checked the bond yield like I sometimes do, and it has. I've been in the mortgage world in Canada for 15 years. I have never seen the bond yield this high. It is teetering at 3.99, nearly 4%. And put simply, guys, yeah, there we go, 3.9. That was a snapshot from just minutes ago.
Hmm.
And I feel like if that was a snapshot, if you look at the lead up to that, I think it might have actually breached over 4% at some point. Now, what does this mean? I think what it means for all of you guys out there is for the last year, this has been somewhere between high twos and mid threes. Okay. 2.9 to 3.5 is kind of where it's been hovering. So it's broken out of that significantly overnight because of these US job numbers. Ultimately, meaning there are too many people employed,
Yeah.
which sounds good, right? But not from an inflation perspective, not from an interest rate perspective. And so, because of what's happened in the States, the bond traders who I don't understand how they think, but they're going, okay, well, you know what? Those economic indicators are too good. Therefore, interest rates will likely need to stay higher for longer. So the bond yield is kind of like a prediction of the future, and therefore it actually feeds into the decisions that also happen at the government level. So it's this kind of it's a circular reference, in my opinion. Oh, the bond yields are up. Okay, we have to raise interest rates. Oh, interest rates are up, and then we're waiting on what happens to the bond yield again. Inflation did come down, but then there's all these other factors, job numbers, that impact it. So it's not just one indicator that we have to watch. It's so many.
Yeah. It's funny. I was at soccer last night, as I was just telling you off camera, and people come up and they know I had this YouTube channel, and the one dude asked me, so let me get this straight. This was his comment, and this is how most people kind of look at it. And he's got a couple investment properties, and he's looking at it, it's like, okay, so interest rates are going up, so banks are making money off of the extra interest payments, but how is it that I'm affected from it? Because here's a great he's got a full-time job as a police officer, uh,
Right.
you know, doing his part for society, everything else, and keeps his finances in check. Yet here's the ripple effect of how the Bank of Canada is trying to control spending from the majority of it, but people like him, great upstanding citizen, he's the one that gets affected, right?
Yeah,
It's
and I mean, ultimately, okay, so a couple of points there. Yes, interest rates are up, and I can understand why he's saying, okay, the bank is making more money. Now, that might be true, but it's not. It's not to the extent that he thinks, because the cost of funds is also up, right? The
right.
cost of funds, if you look at what a GIC was paying you 2 years ago at 1% versus a GIC now at 4%, that means that the bank is paying more to get their hands on this money, which they then go off and lend at 6%. So it's not that the entire interest rate increase is ending up in the pockets of the bank, right? That said, I will tell you that their margins, as from what we're seeing, have actually increased in the
Right.
last little while, simply because the cost of funds is here, but interest rates are set up the bond yields, and they can make these spreads in the middle there. It's
Yeah.
a bit convoluted, but ultimately, if look at the profitability numbers, and they're still very strong for the banks.
Yeah.
Then the second point there is, how is it his problem? Well, the government's made it everybody's problem. Okay, inflation is everybody's problem. Therefore, we're going to try and reduce the cash flow in Canadian households. And if that means that Mr. Police Officer has to now pay an extra $200 a month on his mortgage, well, that's $200 that's not going to go into the retail economy, which is going to drive prices more and more. So, yeah, we're all little cogs in this big machine,
That's
right?
right.
And we're not driving the machine. We're just the little cogs.
Yeah, yeah. And you brought up a great point, one that I failed to think of last night when we were having our conversation is, the way the banks receive money to invest is from, investors. at the
Deposits.
end of the
Yeah.
day. Yeah, deposits and GICs and everything. And I was talking to another investor that I know, and he's in his early 70s. So the way he looks at it, investing is the protection of money as opposed to
Right.
keep generating bigger and bigger and bigger. And in some of his trading accounts, if he leaves his money in just in cash, he's receiving 4.5, 4.7% interest rate. He's like, Garrett,
Yep.
like this is perfect. I live off of that now because of the amount of cash. He's just sitting in cash because the bank has to pay him so much just to keep it.
Yeah. Yeah. And that's fine for him because at his age he
Exactly.
has no debt, right?
That's right.
But for the rest of us who have some debt at 6%, well then saving at 4% or 4.75 isn't going in the right direction, right?
Yeah. Yeah. So, I mean, and the way the point is there's going to be opportunities for everybody. You just need to look for them. And there's some crazy things happening. And if you're sitting in cash, good for you. There's going to be some opportunities over the next several months that will appear that perhaps weren't there, today, even a year ago, and we're just starting to see the early glimpses. I don't think it'll be this summer. I think it'll be next summer of the Canadian, or we'll call it the Ontario cottage industry. With a little influx of listings that we're seeing right now, I don't think we're just going to quite see that yet until next summer. The influx of listings, but we can talk
Right.
about that in future videos. But
Yeah.
yeah, there's lots of stuff going on here, man. And people always ask us, why do we care about what's going on in inflation from the Canada's perspective and the U.S. perspective? Well, pretty much how the U.S. goes, majority of the time, impacts Canada.
Yeah, it's true. The whole that old phrase, what when the US sneezes, Canada catches a cold, right?
Yeah, yeah.
So we are impacted in that way. But look, I don't often do this, Gary, but I'm going to make a prediction.
Oh, here
We,
we
we,
go. Hang on.
we need to,
I
we'll,
gotta
need
get
to
my pen out.
we'll crystallize this. Make sure we put this particular video in the time capsule, and we'll revisit it in December or somewhere around there.
Yeah.
That is that if these job numbers in the US and the bond yield being where it is lead to a rate increase next week, July 12th. If that happens, I feel like right now the chance of that happening is probably around 70 to 80% right now, right? Whereas a couple of days ago it was probably 60%. Okay, so it's highly likely that's going to happen. The next 6 months are going to see a very deflated real estate market. Okay, many buyers who have already stepped out are going to continue to step out. But if you have the wherewithal to buy in the next 6 months, 12 months from now, sorry, 18 months from now, next year, December, my prediction is you probably will be sitting on an asset that's at least 10% more valuable than it was this year. That's what
Interesting.
I believe. Yeah.
Interesting. And that's based on just values and interest rates kind of resetting in a sense over the next 12 to
Yeah.
18 months. Yeah.
So I feel that this next interest rate increase, if it happens, will be enough to kill the economy to the point that it needs to be killed with inflate or with unemployment growth, which is what the government is looking for, right? And therefore a depression in housing for sure, an actual recession probably,
Hmm.
but how long does that need to be maintained? How long do we need to keep rates at that number, right? For us to before we move up. My prediction probably until the end of the year, and then in next year, hopefully early, but maybe Q2 next year, they might start easing rates. At which point the property market will come alive
Yeah.
again, and those who didn't buy will be like, now's the time to buy when everybody else is buying because rates dropped a quarter, and there will be the frenzy that we always see when rates drop.
Yeah. And here's the thing, my friends. We don't talk about this to be the doom and gloom. Trust me, Dion and I are always the glasses half full type of people. However, think about this. I'm seeing it from the perspective of transactions are down, and I lead a large brokerage, and we're seeing that. You're seeing it from the refinances and the mortgage that you're writing. It's not as many. And if we go and talk to any of our lawyer friends, they're seeing the number of deals come in that they have to close whether it be for new mortgages or
Yep.
or properties, they're seeing those numbers down too. So that's just the
Correct.
reality of it, and we need to reset either our business goals and our personal financial goals. So this is why we do these videos, to keep everybody in the loop, and trust me, it keeps us in the loop as well, to help our clients tremendously. So look for those opportunities coming up. There you have it. We've got some predictions. I was going to say bold, but I think it's the reality of where
It
we
is.
are. Those types of predictions. My friend, remind us how to get a hold of you.
Yeah, online at mortgagesbydion.com.
There you have it, my friends. So for Dion, I'm Gary. We're going to start doing some weekly podcasts, weekly videos. We'll see everybody in the next one. Bye for now.